Chapter 1, Introduction to Corporate Finance. In this chapter, we have no math, it's all concepts, very general things about corporate finance, which is what FRL 3000 is about. First, we will look at the main three questions in corporate finance. Then we will look at forms of business organization. In other words, how a business could be structured, like you're the only business owner or you are in some partnership type business, and so on. Then the goal of financial management, then the so-called agency problem, what it means, in which form of business organization this is a problem, and how a corporation is controlled. And the last topic is on financial markets and how a corporation fits in. First, what is corporate finance? If you imagine a firm, let's say a pizza restaurant, then first you can think of where the money for this business would be coming from. And we can say that there are generally two sources of capital or funds. One source is from the owners, so maybe it's a partnership, right? So the owners, the original partners, they each pitched in some amount of money. And the second source of money is maybe money borrowed, such as a bank loan. So what happens with this money? Part of it is invested into short-term things, and the rest is invested into long-term investments. And the money will be working for the firm and generating even more money. So the first question is related to where the money is coming from, the cash inflows for the firm, called capital structure. The second question is called working capital management. In other words, how will the firm manage its everyday activities, such as selling its product to customers, borrowing money short term, paying to its suppliers. What about any sort of time delays with receiving money when the product is sold to the customers, things like that. And the third question within corporate finance is called capital budgeting. So this is all related to planning money for a long-term project, something that would be running for a number of years and require costs over a number of years and profits coming in again over a long-term time period. Capital structure can also be called a mixture of debt and equity. Debt is money borrowed, like loans. Equity is basically how much something is worth. So something that is yours, that does not need to be paid back with any sort of interest on top of it back to some lenders. For example, imagine Professor Chernobyl buying $500,000 house. Typically, banks require that you pay 20% of the house price out of your pocket. So I would be paying $100,000, which is 20% of $500,000 out of my pocket. So savings I have in my bank accounts, right? The money that's mine. This is equity. And the remaining $400,000 would come from a home loan from some local bank. This is debt. Similarly, a company may be worth $50 million, and out of that large number, $10 million would be equity. So this is the money essentially split between the owners. So the owners have $10 million in their pocket essentially. And the remaining $40 million would be debt. So that would come from some sort of loans. And the question on debt to equity ratio includes things like how should we decide on the proportions of debt to equity? Should they be 50-50? Should they be preferably no debt at all? And if there is any debt that a company is planning for, which type of financing should it use? So probably it would be determined by which type of financing is the least expensive. The second question is called working capital management, and it has to do with so-called short-term things, whether they're spent or whether it's the money that the firm has to spend or that it will be receiving. Essentially, you can imagine a standard balance sheet, and the two items that are important there are current assets on its left-hand side and current liabilities on its right-hand side. So it's things that are cash or that can be quickly converted into cash, or things that would be, rather than received, things that would be spent relatively soon, such as current liabilities. So it's all those things that we call accounts payables, accounts receivables, short-term loans, cash, inventory. All those things have to be managed on the daily basis, and they reflect day-to-day activities that the firm has to engage in. So the questions there are, should we buy our supplies on credit or should we pay cash? What are the advantages of each type of purchase? Should we sell our product to customers on credit or should we require them to pay cash? How much cash should we have set aside just in case? On the one hand, if we have enough cash to cover unforeseen expenses, that's a good thing. On the other hand, too much cash may not be wise because it's just sitting there. It's not really working for you. It's not generating any sort of return. And the last question is called capital budgeting. This has to do with planning money, expenses, and receipts long term. So planning long-term investments, making long-term investment decisions. This has to do with how much should we invest into some new business. For example, if it's a pizza restaurant, then maybe it would like to expand and open a second location somewhere. So how much should we spend on maybe buying a building that is for sale? So that would be planning some immediate expense. But this also includes planning down the road, what would be coming in, what would be coming out of the firm. And so essentially we need to do the so-called cost-benefit analysis over all future years that would determine for us whether this new project opportunity is worth investing money into or not. And maybe we have several investment opportunities, not just one. So we need to be able to compare them. How do we compare them? And the last item that's relevant here is what we call risk. How uncertain are future revenues? Are they guaranteed to happen? Are they very unlikely? Are there different possible scenarios? So all of this is captured in what we call capital budgeting. Forms of business organization. If you go to this URL here, it's a California government URL. It shows the general comparison of different ways how a business could be registered in the state of California. For example, you see 7 different forms, such as sole proprietorship, general partnership, C corporation, S corporation, and so on. And for each, it compares the ownership, who owns, who makes management decisions, how taxes are paid, etc., etc. We are not going to look in depth at all of them, but we are going to cover the main three types of business organization. Sole proprietorship, which only includes one owner, a partnership, which has at least 2 people who own it, and a corporation, which has many owners and can be treated as one single legal entity. So, for example, an entire corporation, rather than its individual owners, could be sued as if it's one person. Let's look at a couple of details for each of these 3 types of business. Sole proprietorship. One owner It's the easiest form of business organization to register. Probably takes just a couple of hours. Fill out some forms online. Um, the life of this form of business is limited to the owner's lifespan. Basically, if the owner dies, then the business dies with him. Advantages: easy to start. Um, you're allowed to keep all profits. You don't share them with anybody, and you pay taxes on the income you make from your business, just like you would be paying taxes on your standard job income. So the income from your business is just basically added to your taxable income from your other jobs you might also have. And this is something that will be different for some other types of business organization where income is taxed more than once. Disadvantages: um, because you're the only one who run the business, whatever money you come up with came with when you started the business, that's the limit, that's it. So it may be difficult to expand your business. The second and the most important disadvantage is known as unlimited liability for business debts. What it means is that there is no limit to how much you might be liable for if some problem comes up. Let's say somebody sues you for $1 million. If you don't have that much in cash, you might need to sell your house, your car, and other personal assets. So there is a risk of that. And the ownership is difficult to transfer. Basically, if you decide to quit, then if another person wants to take over, then that's kind of an entirely new business now under a different management. Second, partnership. Like the name implies, it has to be at least two people owning the business. There are two types of partnership: a general partnership and a limited partnership. Under a general partnership, there are at least two partners, and they're both called general partners. It could be 2, 3, 4, or more. And the idea is it's just like the sole proprietorship business form, except it's not one but at least two people. They share in gains, they share in losses, and they all have unlimited liability for all partners' debts. All partners' debts, which means if somebody sues your partnership, then maybe you already sold your house, but your other partner does not have a house to sell. So you might need to cover his share of losses by selling other personal assets that you have. Under the limited partnership, there is at least one general partner that faces all the same pros and cons as general partners under the general partnership, and there is also at least one so-called limited partner. The difference is, first, general partners are the ones making all the important decisions on what to do for their business. They run the business. The limited partners are passive investors. They don't directly participate in making all the decisions. Another big difference is the liability. General partners, as always, face an unlimited liability for all business debts, whereas limited partners have a limited liability. In other words, they will not lose more money than how much they initially invested into the business when the partnership was formed. But it's the general partners that risk potentially selling any personal assets of their own if something costly comes up. And again, advantages, disadvantages, rephrasing what was already said. Advantages: relatively easy to start, just like the sole proprietorship. Unlike the sole proprietorship, there is more money that a partnership can work with, since it's several people. Again, they keep all profits. they probably form some sort of written agreement that specifies, clarifies from the beginning how the profits would be split, whether equally or unequally between the partners. And income is again treated like a standard income from some job. So income received will be simply added to all other income that each partner has as maybe the main job. Disadvantages: the funds that the partnership is working with is still probably pretty limited. So it's not like they may have tens or hundreds of $1,000,000 to invest. And the ownership cannot be transferred easily. If one of the partners decides to quit, then basically the original partnership breaks. Now, maybe they continue operating with fewer people, or maybe they invite a new member to the partnership. But either way, the original written agreement does not hold anymore and would need to be completely rewritten since the partnership is now dissolved. And the last item, the limited partners, as was said on the previous slide, have a limited liability for business debts. That's an advantage of being a limited partner. The general partners face an unlimited liability for business debts, which makes this a disadvantage for this type of partners. And finally, the corporate form of business. Who are the owners of a corporation? For example, who are the owners of Facebook? It's not a couple of people. It's actually probably thousands or maybe even millions of people all over the world who at some point bought shares of stock from Facebook. So those are stockholders of Facebook, of this corporation. What is meant by the separation of ownership and management? The idea is those people who own shares of stock, maybe you own a share or a few shares, you are not actually managing the company. There are different people who manage the company. So there is this separation of who owns it and who manages it. And another thing that's covered with this concept is that the ownership can be transferred, but the corporation still exists. What this means is maybe you decide to sell your shares of stock today, right? So somebody else will buy them. It doesn't mean that since the composition of the owners of the corporation has now changed, that the corporation ceases to exist. No, it's still there. It keeps running its business, but the ownership is now different. And since stocks are traded daily, many times, the stock shares switch hands all the time. This is kind of natural for a corporation. So the ownership composition changes all the time, but the management is still the same and the company continues to operate. Advantages. Since a corporation is a much larger form of business, it has a lot more funds available to it. It can also raise additional money. Maybe it would like to expand. Maybe it would like to buy its competitor for millions and millions of dollars, right? How would it get the money? It can sell additional shares of stock, and each would bring maybe a couple $100, and combined they bring the necessary hundreds, millions of dollars to make some sort of large investment. The owners, who are the stockholders, right, they basically share in profits. They have a limited liability for corporate debts. In other words, if I own a share of stock of Facebook, the money I paid to get those shares is the most I have lost, right? If somebody sues Facebook, nobody will come after me and ask me to pay more money to cover the cost. And in finance, we say that, at least in theory, firms have an unlimited life. So as long as a firm is profitable and successful, it will be around forever. Disadvantages: it's a lot more difficult to start a corporation. It's a long process which has to be approved by the so-called um, Securities and Exchange Commission. A lot of paperwork, a lot of approvals, different stages of the process. Another big disadvantage is called double taxation of corporate income. What it means is, first, when a corporation makes money, it pays taxes on that, following the corporate tax income tax rates, which is now 21% flat. And then whatever money is left is used to pay the share to each owner, each stockholder, right? So basically it's what we call dividends that are paid by the firm to the stockholders. And because for the stockholder, the dividends received from the firm is an additional income, it needs to be taxed too at the personal income level. So basically we have 2 times that income made by a corporation is taxed on the corporate level and then on the personal income level. There are a couple of other variations of business organization forms. For example, there is a hybrid form called limited liability company, LLC, and it includes, the best of both worlds. So it has elements of a partnership where income is taxed only once, and it has elements of a corporation where the owners face a limited liability for business debts. But there are a lot of details for each of the form of business organization covered here. We're not going to go in all the depth, just the general overview. And each form of business has its own advantages and disadvantages. So if you ever consider, starting a business, maybe alone or as a partnership, you should definitely carefully look at all the pros and cons before you make your decision. Goal of financial management. So in a corporation, and now we are just going to focus on the corporate form of business, stockholders are the people who own that corporation. But due to the separation of ownership and management, they are not the people who manage the company. So they're not directly making any business decisions. It's whoever manages the corporation. Stockholders participate in electing the board of directors, who in turn hire managers that represent the owner's interests. So what should be the goals of the chief financial officer, CFO? If you think about it, the chief financial manager or officer should be making such decisions that would make the owners of the corporation, whose interests he represents, happy, right? And to make them happy, it makes sense to say that the CFO should be making such decisions that would be increasing the current value of shares of stock, making the current value, today's value, as high as possible. If you think about why that actually makes sense, is because the stockholders are only receiving the so-called residual money. They're the residual owners of the corporation, because they're getting their money, their dividends, right, on each share, after everybody else has been paid their dues. And by everybody else, we mean employees in the company, suppliers to the company, lenders who gave money to the company, the IRS, who is entitled to get taxes on corporate income, and so on. So the stockholders get only what's left. And so what's left is a large amount of money, then it implies that everybody else who has stakes in the company, such as employees, suppliers, and so on, are also happy. Unfortunately, because the managers and the owners are, do not overlap, it's two different groups of people, there's something called an agency relationship, which has some problems. In general, agency relationship means there is a principal and there is an agent. Principal hires an agent to represent his or her interests. In the corporate setting, stockholders are the principal, and they hire managers or an agent to run the company and represent their interests. The problem is known as the so-called agency problem. It's a conflict of interest between the principal and the agent, between the stockholders who own the corporation and the managers who manage it. So why is there a problem? Why would there be conflict of interests? Let's say me, Professor Chernobyl, right? Who am I, a principal or an agent? Well, I have a job at Cal Poly. Cal Poly is the principal. It hired me. I become the agent. Why did Cal Poly hire me? To teach, or at least that's the main part of my job, right? So I was hired to teach for you guys. What may be a conflict of interest between Cal Poly and me? Well, I might want to get as high of a paycheck as possible and do as little work as possible, hypothetically, of course. And on Cal Poly's side, my employer, it's actually hypothetically something similar. Cal Poly wants to pay me as little as possible, hypothetically, and have me do as much work as possible, right? Of course, it's all kind of a joke, but you can probably think of similar situations in a workplace in general. So what are examples of conflicts of interest between the owners and the managers of a corporation? For example, the owners may want, it may be in the owner's interest that the company makes some big decision, but the managers are against it. For example, it's actually a known fact. If you look at the real life data on mergers and acquisitions, you would see that typically companies that are being acquired by somebody else, right after the acquisition, the stock price goes up. And so it makes sense that stockholders of the company that is being acquired should be in favor of this takeover attempt, right? Because their stock price will go up. It will make them richer, wealthier. But oftentimes the management would oppose the takeover. Or on the other side, the company that is the acquiring firm, right? Managers, again, if you look at the data on how companies acquire other companies, let's say their competitors, you would see that typically companies pay a premium, so more than what the other company is actually worth today. And that premium comes of where? Well, it kind of comes out of what the stockholders of the acquiring firm would have received as dividends, right? So the managers overpay to take over another firm, which reduces cash remaining for the owners of the acquiring firm, which is again an example of a conflict of interests. And you can think of other examples like corporate, managers buy corporate jets, and other, you know, making other expensive purchases, which are viewed as, just for themselves. They pay themselves high bonuses at the end of the year, things like that. But clearly, it comes at the corporate owner's expense. Are there any ways to, eliminate the conflict of interests, the so-called agency problem? Well, the managers and the stockholders' interests need to be aligned somehow. Are there any ways to do that? There are a couple of ways. For example, there may be job prospects for managers successfully pursuing stockholders' goals. So a manager might be hired and offered promotion, in a few years if the stock price goes up, which makes managers work harder to increase stock value in order to receive that promotion in the future. Another way this could be, the interest between the two groups of people could be aligned is to offer the managers a compensation that would include the base salary plus the so-called stock options. This is actually pretty complicated. It's beyond the scope of this class. But stock options are financial securities that are determined by how much stock shares are worth. And the idea is the higher the value of stock shares, the higher the value of those stock options that the managers might own, personally. And so again, it gives an incentive to the managers to work in the interest of the stockholders, make sure they make the right decisions that would result in an increase in stock price, which will then increase the value of their stock options that they can sell later after a few required, years of the waiting time, and benefit financially. Financial markets. What are financial markets? When you see the word market, you probably think about a marketplace, like some physical place where people come to shop for something. Well, financial markets does not have to be some centralized location where buyers and sellers meet and trade products for cash. But it is a more general term on where financial securities are bought and sold. So what do you mean by financial securities, and how can they be bought and sold? First, financial securities include two important things: stock shares and corporate bonds. So these are the two financial securities that a company may sell in order to raise money, for example, to expand and grow its business. What are stocks? Stocks represent profit, the residual after all expenses such as wages to employees, money to suppliers, taxes, interest payments on loans have been paid. So this is what's left for the owners of a corporation. And the owners of a corporation are stockholders, people maybe like us, people who might be coming from all over the world, who are buying shares of stock of some company that they like. So shares of stock are also called equity. Equity, you can think of a standard balance sheet, which has assets on the left-hand side and liabilities and equity on the right-hand side. So equity is what you would get if you sell all assets for cash and use the cash to pay off all liabilities, all debts that you owe to somebody, whether it's suppliers or banks or other lenders. So equity is the residual, it's what's left. And that's what's left for the owners of a corporation. So stockholders, the owners, they receive what we call dividends. And basically, and this time you can think of an income statement. That's nothing but net income, the bottom line of an income statement, divided by how many shares there are. So that's the dividend per share. So shares of stock is one of the two types of financial securities that a corporation can sell. The second one is corporate bonds, which is also called debt, or how much is borrowed. So when a company sells a bond, it basically borrows money from whoever buys that bond. Let's say you buy a bond from the company. You are like a mini bank. You just lend the money to the company. How much money? Exactly how much you paid for the bond. And so the company, as a borrower, will be in return paying you interest. This is something we will be looking at in chapter 7 in this class. And stocks will be covered in chapter 8. So the firm pays dividends to stockholders on the shares that they bought, and interest payments on bonds to the bondholders. This figure on this slide, it's figure 1.2 in the textbook, shows cash flows between the firm and the financial markets. So the firm is the yellow shaded area on the left, the big box. The financial markets is the sort of grayish, bluish area on the right. The arrow labeled as A, firm issue securities, shows how money comes to the firm from the financial markets. What exactly is it? All it is from the previous slide, the firm selling things like stocks and bonds to whoever wants to buy them and receiving money for that. Now the firm has more money to work with. It has just raised cash. Then the firm invests cash into its projects, into its business. Hopefully it grows larger, makes more money. What happens to the money it gets? Like revenues, essentially. It has to, basically it goes, we say, in three main directions. One, that's labeled as F on the figure, dividends and debt payments. That's essentially the money going back into the financial markets. Dividends as payments to stockholders, and interest payments as payments to bondholders. That's one of the three directions where the money flows out of the firm, the cash outflows for the firm. The second direction is labeled as C, cash flow from firms' assets going to the government and other stakeholders, labeled as D. What is that? Taxes. That's basically all it is. It's mainly taxes that corporations are required to pay on their corporate income every year. And then what's left is labeled as E, reinvested cash flows. So some money will remain. What does the firm do with it? It kind of, uses it for its businesses, to expand even more. So the money gets reinvested. The money flows as dividends and debt payments to the financial markets. Part of the money is paid as taxes, and the remainder is reinvested back into the firm. Then the next slide talks about looks at a little bit more details on how firms sell stocks and bonds. So a firm decides to expand. Maybe it needs money to buy its competitor, right? It's probably millions of dollars, if not billions of dollars, that we need. No firm would have that kind of cash lying around, so it would need to raise cash. It can do that by selling stock shares or by selling corporate bonds, or both. So investors, stockholders, and bondholders buy those two types of financial securities. And now the firm has raised some cash. This is called primary markets. Stocks and bonds are sold for the very first time. They can be sold as a public offering, meaning anybody in the world can pay the listed price and buy stocks or bonds. Or they can be sold in a private placement, which means only a relatively small group of rich investors has access to those financial securities. Now, investors just bought stocks and bonds. What happens next? What happens is what is known as the secondary markets. That's stocks and bonds being resold over and over and over and over again. They start switching hands. They're traded on Wall Street, on New York Stock Exchange, they're traded online. They start switching hands. All of that is called secondary markets. There are no market number 3, tertiary markets, market number 4. It's all called secondary markets. And they can be resold through dealers or through brokers in an auction. So let's look at a couple of examples of how secondary markets work for stocks. Dealer markets and auction markets. Dealer markets are also known as over-the-counter markets. That's because there are many locations where the trade occurs. There is no one physical location. The dealers, they buy stocks and then they sell them on the phone or electronically online to potential buyers. So they basically bear the risk of not being able to sell either all shares or at the price that they would like to get. But in general, they're buying them for a low price, sell to the interested buyers at a high price, and they make, profit on that difference in price, which is known as the bid-ask spread in finance. An example is NASDAQ, which stands for the National Association of Securities Dealers Automated Quotations. That's where over 3,000 company stocks are traded on regular basis. It's primarily smaller company stocks, and the trading is not as active as in the famous New York Stock Exchange. The New York Stock Exchange is an example of an auction market, the second type of secondary market. This is a centralized location. There is a physical location on Wall Street in New York where stockbrokers are physically present to trade on behalf of their clients. It all looks like an auction. They're, bidding their prices, and eventually the trade, takes place. So New York Stock Exchange is open on business days, Monday through Friday, excluding national holidays, 11 of them, and weekends. So there are generally 250 to 252 trading days in a year, and that's it. This is where there are restrictions on which companies are allowed to have their stock listed on this trading platform. It's large companies. In order to be listed, they need to be worth at least $100 million. And this is where you see, again, close to 3,000 different company stocks traded daily. Summary of Chapter 1. First, we covered 3 main questions of corporate finance. First, capital structure. Capital structure refers to how much money is borrowed and how much money is not borrowed, or equity. So should we borrow? Should it be 50% borrowed, 50% not borrowed? Should it be primarily money that is not borrowed that the firm is using for its businesses? That's all part of capital structure. Question 2, working capital management. This has to do with planning money to be invested for short-term activities of a firm, managing everyday activities, things like how much cash should be set aside to cover any unforeseen expenses, how much to sell on credit, paying money to suppliers, should it be paid on credit or paid in cash. And the third question is capital budgeting. This also has to do with investing money, but rather than for a short term, which is a period of time under 1 year, it's for a long term, which is uh, anything longer than 1 year. So, in other words, planning long term investment activities. For example, maybe an example of such activity is expanding business. Let's say a restaurant chain would like to open a new location somewhere in the area. That new restaurant would be a long term project because it would be bringing money over possibly many years. And the main thing that's covered in this area of corporate finance is evaluating an investment opportunity, a long term investment opportunity. Is it worth investing money into it or not? It's worth it if the money we invest today is less than the total amount of money that we would receive back in all future years. Then the chapter looked at three main forms of business organization in the USA. The three main forms are sole proprietorship, where you are a single owner, a partnership, where there are at least two people who share in profits, and a corporation, which may have millions of owners. For each, we looked at what those are and advantages and disadvantages. The main disadvantage for some of these business forms is called an unlimited liability for business debts. That's when, let's say, you're sued, your business is sued, and you don't have enough money to cover the costs, and you are liable for covering the full cost of the lawsuit, for example, and for that you may need to sell your personal assets such as your house, your car, and so on. That's an unlimited liability for business debts. In which of these three forms of business organization do we see it? Sole proprietorship, and within partnership it's for so-called general partners. There may be general partners and limited partners. General partners face this risk. Limited partners, they do not. They have a limited liability for business debts. And the most they lose is the money they brought in when the partnership was started. In a corporation, all owners, which are stockholders, there may be millions of them, they all face a limited liability. Then in the corporate form, there is something called the agency problem. Because unlike sole proprietorship and partnership, where the business owner or owners are also the ones who run the business, in a corporation it's separated into two different groups of people. Those who own it, stockholders, and those who run the business, the managers. The agency problem is a conflict of interests between these two groups. We looked at more details on it, some examples, and how it could be resolved. And the last part of the chapter was on financial markets. This is a general term describing where and how financial securities that the corporation may issue to raise cash, such as stock shares and corporate bonds, where they are traded. There is something called the primary and the secondary market, where, for example, stocks may be traded. A primary market is when stocks are sold by the company for the very first time and investors buy those shares. The secondary market is everything that follows from that point on. So investors start selling shares, new investors buy those shares. In other words, stocks start switching hands. This is all called secondary markets. How can stocks be traded? How is the price determined? They can be traded in an auction setting by brokers who represent, who participate in the auctions, such as New York Stock Exchange, on behalf of their clients. And also, stocks can be traded by dealers who buy shares and then try to sell them for a profit and make money on the price difference. So the dealer market example is NASDAQ, National Association of Security Dealers Automated Quotations.